Hello, I'm Mike Bolan, and I lead the UK-US corridor for KPMG, based in New York.
Hello, my name is Chris Wilson. I'm also a UK tax professional based here in New York, and both Mike and myself focus on US groups with a presence in the UK and Europe.
Welcome to this video, during which we're going to be talking about an exciting development in the UK, the introduction of the new Qualified Asset Holding Company regime. The new regime was introduced in the spring of 2022 and seeks to provide rules that will encourage funds to base their asset holding structures in the UK. This development is likely to be of interest for US asset managers, and in particular those managers that have a presence in the UK and/or are seeking to invest in assets located in the UK and/or Europe. So let's start with some background to the regime. Chris, perhaps you can talk to us about the policy intent behind the introduction of the new Qualified Asset Holding Company rules.
Thanks, Mike. Sure. This is an exciting development within the asset management space and reflects the UK government's strategic focus on the asset management industry. There's a significant amount of asset management activity in the UK. However, it has been noticed that often assets are not held within UK structures. This prompted the UK government to consult on why this was the case and what might the benefits be of creating an environment to support asset holding companies being located in the UK. The introduction of the Qualifying Asset Holding Company regime is part of a series of reforms and developments by the UK government to support the asset management industry in the United Kingdom. Put simply, the aim of the new regime is to encourage the use of UK tax resident holding companies for investments made by funds and institutional investors. Through a period of consultation with industry stakeholders, the UK government identified issues within the UK tax system which appear to deter the use of UK tax resident vehicles. This new regime has been designed to amend the UK tax rules for qualifying asset holding companies with the aim of broadly treating investors as if they were investing directly in the underlying asset or assets. In effect, the Qualifying Asset Holding Company regime seeks to remove the tax impediments which deterred the use of UK structures when compared to other jurisdictions.
Thanks, Chris. And you're right, the UK Qualifying Asset Holding Company regime has been designed to identify features of other favourable international holding company regimes and broadly to try and apply them within a UK tax construct. Having talked about the policy intent and the background to the establishment of the regime, let's talk about some of the key benefits of the new Qualifying Asset Holding Company regime to those entities participating in it. The Qualifying Asset Holding Company regime has been established as a ring-fenced regime within the wider UK corporation tax system. This means that UK tax resident companies that pass certain eligibility conditions can access the enhanced features of the Qualifying Asset Holding Company regime. As set out here on the slide, the aim of the regime is broadly to provide a tax-neutral UK holding company vehicle with minimum taxation comparable to other similar platform regimes based on the holding activities performed by the entity. The UK authorities have been clear from inception of the regime that the Qualifying Asset Holding Company regime is not supposed to be in of itself a revenue-raising exercise. Rather, it is about attracting this type of economic activity to the UK and therefore supporting the growth of the asset management and fund management sectors in the UK as a whole. There are some limits placed on the use of the regime. It can only apply to investing and not trading activities under UK tax principles, and it does not apply to UK real estate or intangible assets. In terms of the features available, however, there are some real enhancements and adaptations to the general UK corporation tax rules that apply to standard UK companies that make the new regime very compelling to asset holding activity across various strategies. At a high level, these include providing a broad exemption from tax on gains from shares and non-UK land, providing the ability through deductions from financing from a variety of instruments to ensure taxation is minimized within the entity itself and is comparable to other regimes utilized for such asset holding activity, providing an exemption for foreign taxed property business income, meaning in relation to foreign incoming assets, the Qualifying Asset Holding Company regime operates very favorably, and ensuring no withholding tax on interest payments, affording additional efficiencies in financing these vehicles. Remembering, of course, that the UK has a broad dividend exemption and no withholding tax on dividends as a matter of law. These are very compelling features of the regime. The next slide discusses the eligibility criteria for entities wishing to elect into the regime. The overarching eligibility rules are: the company must be UK tax resident. Note, not necessarily UK incorporated. So for example, one could have a Jersey incorporated UK tax resident entity enter the regime. This condition adds additional flexibility to the entities capable of accessing the regime and means we are seeing groups looking at the regime in the context of both existing and future holding company structures. The company must not be a UK real estate investment trust, and no equity securities of the company may be listed or traded on a recognized stock exchange or any other public market or exchange. If these conditions are met, there are two further groups of eligibility rules focusing on ownership and the activity and strategy of the vehicle. Let's start with ownership. The sum of the relevant interest in the company held by persons who are not Category A investors must not exceed 30%. For the purposes of the ownership condition, Category A investors include qualifying asset holding companies themselves, certain public authorities, certain diversely held qualifying funds, long-term insurance businesses, UK REITs, non-UK REIT equivalent vehicles, and certain pension schemes. So if you have a UK tax resident company that is at least 70% owned by Category A investors and meets the other conditions noted above, the last conditions to be satisfied are in relation to activity and strategy. The main activity of the company must be the carrying on of an investment business. This means any other activities of the asset holding company, if any, must be ancillary and not carried on to a substantial extent. In addition, the investment strategy of the company must not generally involve the acquisition of equity securities that are listed or traded on a recognized stock exchange, except for the purpose of facilitating a change of control. Finally, an election into the regime must be made to HMRC prior to entry. HMRC have indicated a willingness to discuss the regime with potential applicants, and there may be scope for making a non-statutory clearance application to get comfort on the application of the regime to particular structures. Indeed, we at KPMG are already consulted with King's Counsel on some of the points related to the new regime, and as I said, are finding the UK authorities receptive to queries and questions in relation to the application of the regime. So, we've talked about what entities may qualify for the regime. Chris, perhaps you can discuss some of the key features available to companies within the qualifying asset holding company regime in a bit more detail.
As Mike mentions, the regime provides for no chargeable gains on the disposal of qualifying shares. The standard UK tax regime has a gains participation rule known as the Substantial Shareholding Exemption, or the SSE. The SSE has certain conditions attaching to it. This regime eliminates the need to rely on the SSE and therefore enhances and simplifies this exemption for qualifying companies. Qualifying asset holding companies suffer no additional tax on overseas tax property income, and gains derived from the disposal of overseas land are exempt, affording additional flexibility for the use of these vehicles for such assets and scenarios. There's a broad withholding tax exemption on interest paid to all parties, i.e. including both related and unrelated parties. Standard UK companies are subject to 20% withholding tax, and although this can often be managed, the broad withholding tax exemption will simplify the qualifying entity's administration. In relation to profit participating or profit dependent debt instruments, historically the tax deductibility of such instruments has been challenging in the UK. For qualifying asset holding companies, profit participating or profit dependent finance is explicitly permissible under the qualifying asset holding company regime, meaning there should be no disadvantages of using such instruments. Specific sections of the UK's hybrid mismatch rules are also switched off for qualifying asset holding companies, particularly as they relate to hybrid instrument funding, which is helpful and broadly puts the regime on a similar footing to other platform regimes in relation to hybrid mismatch rules. However, remember, consideration of hybrid rules in other jurisdictions, for example the US, may also be required. There are specific rules that relate to the preservation of capital gains treatment and eliminate stamp taxes on redemption of a qualifying company's own shares or loan capital that will be beneficial to certain investors. So overall, Mike, there are some very interesting tax developments available once access to the regime is established.
Thanks, Chris. I wanted to bring this to life, so on this slide we show a simple example intended to demonstrate some of the features and eligibility conditions we have been discussing. Here, we have an entity in the middle of the diagram acting as the holding vehicle beneath the fund for a number of local bidcos that then hold various targets and assets. In order to illustrate some of the potential benefits of the regime, we are assuming that the holding entity receives interest and dividend income and is funded by a profit participating note. Starting at the top of the diagram, in order for the UK tax resident vehicle to become a qualifying asset holding company, it would be necessary for the fund here itself to be a qualifying fund and therefore meet the ownership condition. This will involve a determination of whether the investors in the fund are predominantly Category A investors, whether there is concentrated ownership in the fund, or whether there is genuine diversity of ownership conditions are met, how carrying arrangements of the structure impact these conditions, and so forth. There will be an analysis needed to determine these points. Assuming the ownership condition is met and the other eligibility conditions are also met, for example, activity, UK residence, no listed securities, not a UK REIT, the entity has made a notification, the company here could in principle become a qualifying asset holding company. Then in terms of income flows received, dividends would be exempt in the qualifying asset holding company, although this is a benefit of the wider UK system, not just the qualifying asset holding company regime. Interest received will be taxable in principle, although the PPN would be expected to provide deductions on financing, leading to a transfer priced margin of taxation being obtained in the entity. In terms of gains, any gains on the disposal of bidco entities would be expected to be exempt, assuming the entities are not UK property rich. There will be no UK hybrid rules impacting on the PPN from a qualifying asset holding company perspective. If there are UK investors in the fund, they may wish to obtain returns in capital form via a share repurchase event by the qualifying asset holding company. This should be navigable without creating taxation in the holding company itself. Although we are showing a single UK asset holding company here, in practice we see chains or stacks of qualifying asset holding companies utilised in fund platform structures, which we'd expect to obtain the same treatment being illustrated here. The last bullet point is noting that although we are showing a predominantly equity holding strategy, it should be possible to obtain similar tax neutral or margin treatments on credit or overseas property type investments. So that's a quick visualization and walkthrough of the points we've been discussing in relation to a simple example. Chris, back over to you.
Thanks, Mike. Finally, I thought it might be worthwhile noting that KPMG in the UK was actively involved in the consultation surrounding the development of these rules. As you look at the content on this slide, viewers might be interested to hear that elsewhere on KPMG's website, you'll find information about the EU's proposals in relation to the introduction of substance rules for shell entities, known as ATAD 3. In this context, we're seeing many groups reassess where it's appropriate to locate their holding companies. It is important to highlight that as the UK is no longer a member of the European Union, the UK no longer is required to abide by, nor has access to EU tax directives. Accordingly, the ATAD 3 proposals should not be relevant for UK entities, including qualifying asset holding companies.
Thanks, Chris. So in summary, the takeaways are the new qualifying asset holding company regime has arisen as part of a wide-ranging review in the UK, which is looking at enhancing the UK's competitiveness in the asset management space. For qualifying companies, the enhanced tax features within the regime make the qualifying asset holding company entity an attractive and competitive alternative holding company vehicle to similar regimes in other jurisdictions. Some traditional holding company locations are facing additional tax transparency, reporting, and controversy challenges, meaning a lot of organizations are now taking the opportunity to evaluate the qualifying asset holding company as a holding company option. And thirdly, there are qualifying conditions that need to be met in order to elect into the regime. Therefore, advice is required in relation to electing into the regime, as the applicability of the rules will be fact dependent. The introduction of the qualifying asset holding company regime is an exciting development in the UK and may be of particular interest to US investors or investors into the US. Given these new rules, alongside with reforms elsewhere around the world, this is a perfect time for asset managers to review their holding company structures. We recommend that detailed consideration of the new qualifying asset holding company regime is given to see whether it will be applicable and beneficial in your fact patterns. So thank you very much for watching this video. We hope you've found it informative, and please do reach out to us if you have any questions on the topics covered today. Thank you.